Okay, so welcome back. I know it's been a while since I've made a video, but I've been quite busy outside of trading and making these videos, but I'm back now. So I appreciate all the support and the likes and the subscriptions. I'm trying to push to 200 subscribers now, so if you aren't subscribed and you're watching, then it doesn't take long to drop a quick subscribe. It's much appreciated, very helpful. Keeps me motivated to make more videos. But this is going to be me sort of going over some liquidity inducement lit notes that I took from some of their course. So yeah, I just have, this is a quick bit of analysis I've done on gold, so just in case you wanted to see. But we got a valley formed. I've done the volume profile from the Friday, or from the Asian, London and New York session prior to Friday's price action, and as you can see, volume is a lot lower below price at the moment. So I've got these levels marked out, sort of 3 key levels I'm interested in. They're not the trades I would jump straight into. I would look, once price obviously alerts here, I would drop down to say 15-minute chart and I'd look for lower time frame confirmations of entry and see how we retrace and reject. But I've also got these two FTMO accounts I was just going to quickly go over the metrics on. So 100k account size, started off, as you can see, this is only a free trial just while I was doing some testing, but overall quite good results. Very minimal drawdown, 1.8%. These are the days, obviously that was just to get the minimum days done, but quite profitable days. Good profit factor of 2.62, win rate 60%. Obviously average profits higher, which is good. Those are the trades there, so that was a good one. And then the other one I did, these were done back to back. This one was a bit more choppy. Obviously we had quite a bad loss there, but recovered it with, there was a sell on AU, which I think I covered. But yeah, we had a nice recovery on AU, which took us to the win. Again, 54% win rate, not as good profit factor, but better average profit over loss. Those are the trading days, so we had a couple of losing days and then the rest were profitable. And I have started a Instagram account. It's called English Forex, and I'm going to try to sort of keep my journey up to date on here, because so far I've been keeping it up to date on my private Instagram, but I want to try and sort of move into keeping a public track record and sort of share things on there. So if anybody's interested in what I've been posting and sort of following along and learning for themselves, I'll be posting some posts, and I'm going to try and sort of brand it a bit to keep it updated and post some highlights and things of trades I've taken and entries and analysis and stuff like that. So give it a follow if you want to. But anyway, on to the notes. So this is a EURUSD 5-minute case study from the LIT, Liquidity Inducement Course. Some of you may have heard of LIT. If not, they're a trading company slash mentorship that sort of have their own strategy which they've shared. It's to do with institutionally funded candles and things like that. So basically what they look for is build-ups of liquidities and institutionally funded candles. So this can be in the form, liquidity can be found in the form of either equal highs or equal lows, and it shows that there's liquidity above the zone in terms of equal highs, or liquidity is below the zone in terms of equal lows. So liquidity above is known as buy side liquidity, and liquidity below is known as sell side liquidity. And once liquidity has been built up, it can now have the potential to be taken out, and this is seen as a liquidity grab. They call it an FU candle because it's sort of, they say it as an FU to retail, because it's sort of, well, as you can see here, outlined in blue, you can see the accumulation of orders creating the equal highs. So as we just mentioned, equal highs will be formed here, which means there's buy side liquidity above them which can be taken, and normally buy side liquidity will be grabbed or taken for a move down, and vice versa, sell side liquidity will be taken prior to a move up, and it's to sort of trap retail and get them out of the market before a move like this would occur. So we want to obviously try and capitalize off a move like this. So the FU candle would be this candle circled in red, and that would grab all the liquidity from these equal highs and then fuel the sell side push. But to obviously ensure that this candle is valid, you've got to make sure that it does run a valid liquidity zone. So an example of a valid liquidity zone: equal highs, equal lows, previous highs or lows, ranges or session highs and session lows. The Asian high and low are very strong liquidity zones, because this is the session obviously prior to London, which is where a large amount of the volume's traded. So then we would get our entry on the retest. So you'd retest the institutionally funded candle, induced early sellers which caught the liquidity grab. So obviously a lot of people will be selling into this candle, and then as they see this first drop, they'll think, oh, it's off, and they'll roll their stops into profit slightly, so their entry's protected. And that's what this retracement here will be trying to tap out, people that have done that, and then the move will occur. So this is our desired entry point, and the stop loss would be placed just above the top of the candle, and the target would be the previous structural low point. So you could set an alert sort of here for partials, move your stop to break even, because that would be a major breaker structure and sort of fuel the continuation there. So as we can see, below price has just tapped. So as you can see, so below price has tapped into an imbalance zone and has pushed away from it. So that's here, imbalance zone, right there, circled in blue. To a common retail trader, this would be a buy signal, entry confirmation, as the imbalance has been filled and the price has turned bullish and is forming lower time frame bullish structure, such as breaks of structure. So imbalance filled, tapped, and price has gone off, broken this sort of small structural lower high, and retail would be thinking, this is buys now, we're going to break this structure and this structure. But within the red circle we can see the imbalance in question, as well as the test of the zone in the smaller red circle. So that's the imbalance with the line across, and that's our test, our tap into it. Look at the example from a non-retail perspective, so a lit perspective. We can clearly identify that there's another imbalance below, which was below the imbalance which was just filled. This one, there's another imbalance below, the blue one in the blue box. This is identified. We're expecting price to fill this imbalance and claim the liquidity from the retail push and from the primary imbalance fill. This will provide us with more liquidity, as all the initial orders from this primary push here will be mitigated by this move downwards, as it's not expected by retail. So basically what we're saying is retail have seen the imbalance fill and price tap into. This would be an order block to retail, because you've got last sell candle before a BOS. So they would be looking to buy from this. They've had their buy move, they've rolled their stops, or they've tightened up their risk because they think, oh, we're off. Their target would probably be this buy side liquidity wick or this supply zone. But they failed to see you've got another imbalance below the imbalance they've traded from, which is holding a lot of liquidity and needs to be filled and mitigated at some point. So it's likely what we're looking for is price to drop, take out all these retail traders, fill this imbalance, and then trade from it. And as you can see, we've got a trade limit set halfway in between this imbalance, and the stop is just below structure. So we'll continue. So this was the push we just saw, obviously. No, sorry, this was the push we just saw. This was that buy side liquidity that I said retail would be targeting, and this was where we left off. So as you can see, as we expected, the FU candle was formed, which mitigated the equal lows identified by the green rectangle. So we broke these lows. The liquidity was claimed from the initial retail push, which is what we expected, so that liquidity has been claimed. That can be seen by the blue rectangle. Now all the liquidity has been claimed, we can look at where price actually is. Price has just filled the lower imbalance that we identified, so that was where this black line was, 50% of it. So that was our imbalance. Price has just filled that. There are now two options of how this specific setup can be traded. You can set a pending order at the imbalance area and make sure you account for your broker spread and allow price to tap into it and trade from it, and have your stop loss below the next structural low point, in our case because we're buying, and have a target set at a relevant structure point. Okay, so that's one way to trade it. Or you can set an alert at the imbalance, so you'd set an alert here, and that will let you know that price has entered your POI, your point of interest, and you can await a lower time frame break of minor structure, which will form an institutionally funded candle, and then you can place either a limit at the open of the institutionally funded candle, also known as an order block, or patiently await the confirmations and place a market order at the desired point of interest once price reaches it. Option 2 will give you tighter risk to reward, but obviously you need to have the time to sit at the chart and be monitoring it and a bit more of a deeper understanding, whereas option 1, less stress, set your limit, set your stop, set your TP, set an alert, you'll get tagged in and you see how it goes. So the red box will show the IFC and the entry point. The line is the minor structure break as mentioned, so you can see we dipped in. This is our imbalance fill, this line, so price tapped it, broke this minor structure here, and then that forms our red box, which is our area to enter from. So we would have entered there where the price is. So, and you can see that's this trade here. This one is this trade here. So the break of the initial imbalance causes disruption to the market as it throws out all of the smart money concepts traders, retail traders, because they're confused why price came back to their entry and either took them out of break even or hit their stop losses. So they were obviously here where I got the cursor, and they bought in at this point, and now here we go. So retail entered here, and we were here when we first said about dropping to fill this imbalance. Price zoomed down, took out their stops, which potentially would have been sort of sat here, or they'd have rolled them to break even here. So they've had their stops taken, and now they're questioning, well, why have I been stopped out? So this will cause them to question their psychology in trade. However, all you need to do is look at the bigger picture and understand the liquidity and where price must mitigate before being able to carry out the complete move. So as you can see, if price had just shot off from there, it would have left this imbalance, and it would have had all of the retail buyers here, and then it would have just formed a bigger imbalance because there was clearly a large amount of buyers buying from this zone, such as retail, smart money. So we had this pullback to mitigate those, and then as you can see, we had a huge move after the singular retest, which is where we jumped in here. So as you can now see, the move has played out. Price respected the lower imbalance area after filling it, and our refined lower time frame entry was respected also, and we were able to have a target above the sell side, above the buy side structure, as due to the build-up of liquidity, it was likely the price was going to break the buy-side structure and claim the buyer's liquidity. Sorry, I've worded that wrong, but basically this is buy-side liquidity, retail buy-side liquidity, buy-side liquidity, and buy-side liquidity. So that's why we've targeted up here, because we want to claim all of that buy-side liquidity. Okay, so this is also like the sort of ping pong video I did, where, let me show you quickly, because if you haven't watched it already, it's definitely one of my better videos. This one here, the EURUSD case study lit, so Liquidity Inducement theorem. This video is a case study of EURUSD, so same as what my notes are on, but a different price action. So it's 23R, 6 ping pong trades, so buys and sells. So if you're interested, definitely give that one a like and a watch. It's sort of goes off similar strategy to what the notes are, so worth a watch. So this is another trade. So TP was obviously hit on that one, and we follow on from the new price action formed once TP hit. So we're looking for extreme structural points for reversals, as this is where the main liquidity is stored. In the example on the right, so this one here, we've induced the previous structural high, which is the first red circle, which was holding a lot of liquidity, and we've also drawn a lot of retail buyers into the market. We know after a move like this that we're going to get a major rejection and retracement. This price can't continue in one direction indefinitely, and obviously a huge imbalance has been formed, which has to be mitigated at some point in future price action. So below we have an example of a short trade setup, which set up after the mitigation of the previous high in the example to the right, as we spoke about. So here within the green rectangle we can see equal highs which formed before the institutionally funded candle grabbed the liquidity from the red circle. So here on price we can see equal highs have been formed, consolidation, and then huge institutionally funded candle claiming the liquidity from those equal highs. So price broke down to the sell side and allowed us to identify a minor breaker structure. So here, this black line is our minor breaker structure. We could pinpoint our institutionally funded candle and await price to retest our entry point. Price didn't retest the institutionally funded candle 100% in this example, however it did fill the imbalance formed, which is also a valid entry criteria. And as usual, the stop loss would be located just above the structural high. In this example, the take profit would be set at a structural low point or imbalance, somewhere where price will aim to mitigate. So as you can see, we filled this imbalance here, so this box is the imbalance. We came in and we filled it, and that would also be a valid sell entry. However, we didn't quite tap the proper entry, but you can enter on market by the fill of this fair value gap, and then the TP would just be another imbalance fill. So there, that's your imbalance, and that'd be a fill. Stop loss just above the protected high, which is the structural high from the point which broke structure. Okay, so this is a continuation of this trade. So here price has tapped into the purple box, which is strong institutionally funded zone / demand zone. Within the green box, so within the green box is equal highs which are formed. This is the green box, institutionally equal highs. This is a good sign, as equal highs we know hold liquidity above them, because it is an area where the market has been shorted from. This is good for us, as this liquidity can be induced and contribute to our push towards the sell side, towards the buy side, sorry, we now have equal lows which are holding sell side liquidity, which can also be mitigated and used to fuel our buy side push. So here we've got equal lows forming, and we know that this is our strong demand zone in purple, so we want price to break that equal low area, claim the liquidity from those, and then we'd be looking for a rejection within our purple higher time frame demand zone. So this is continuation, obviously. So here we've been tapped into the buy limit order, and the stop loss is just below the institutionally funded low, and the TP is above the structural high, which holds a lot of buy side liquidity and can be induced. So this is our buy side liquidity, and our TP is obviously just above. Remember, we obviously had our equal lows here, which price has claimed. Buy side order was here, and we've been tapped in. Okay, so continue on. Following the same breaker structure rules as I previously spoke about, the second buy position was entered at this point because price broke the minor level of structure and formed an institutionally funded candle, which is our entry point for the buy, and the stop loss was put below that specific institutionally funded candle structural low, and the target was the same as the initial buy position because structure hasn't changed, so it's the same target and same liquidity. Finally, the buys were closed out before the end of the trading day at the current price in the screenshot, so both positions ended in profit. Obviously right here we got close to stop loss, but not too close. We were still a few pips away, but obviously the main thing, you've got purple, which is your high time frame demand zone, which has been marked out. Then the refinement of that zone is the black line, that is our buy limit. And remember, as I mentioned before, there's the two options: either go on to the lower time frame, set the alert at the area, and then watch price play out, look for that break of minor structure or market structure shift, and then the order blocks slash institutionally funded candle to be formed. And then once price retests that, in our case here, you can trade from that, and then you'd always have your stop loss just below that institutionally funded candle's structural low or high if you're selling. So as we can see here, price came down, formed the institutionally funded low, had a buy off, broke structure, and then we had our IFC area and then our entry, and then we traded off, and we were still targeting above the equal highs here. And obviously, as it says, we sold at the end of the trading day before the market closed at the current price. So yeah, I hope that sort of makes sense to you guys and you enjoyed the video. Obviously, please like the video and subscribe if you are watching and you enjoy it, so I can carry on making new videos for you guys. I'm pushing for 200 subscribers, and obviously I've got lots of other videos sort of on SMC as a free lot size calculator. Like I say, I recommend this one, the EURUSD case study. That's really good, and the gold case study is very good as well. This is a bit of live back testing for you on this sort of strategy, and then there's one now on $3,010 trading GU on an FTMO account, sort of smart money concepts type stuff, but more with the liquidity inducement underlying within it to refine. But yeah, I hope you enjoyed, and like and subscribe, and I'll see you in the new one. Thank you.